Hello everyone. Today in this video we are going to see few more activities related to financial closing. So let us move on to the next slide and see the activities related to value adjustment part of receivables. So value adjustments. So what are value adjustment? Value adjustments for receivables are performed in one of two ways. So it's an individual value adjustment or flat rate individual value adjustment. In individual value adjustment, this is a posting for a specific business partner account for which you have determined the open amount is unrecoverable. If you feel that debtor is going to be a bad debt, so at that time we will do this value adjustment. You post with a special general ledger transaction. So by debiting the expense from the individual value adjustment account and crediting the customer account through the special GL indicator. By default it is E to the individual value adjustment account. So here we are going to debit the expense and also credit the customer, but we will assign in value adjustment account through the special indicator configuration. So there is one more method, flat rate individual value adjustment. You can use a program to execute mass rule based adjustment postings for value adjustments, that is individually, but this one is we can do in bulk in the mass. Okay, so you customize the process and then execute the value run. So there will be some configuration for this part because we are doing with the number of documents. Definitely we need to pull the documents based on some criteria. You must configure the value adjustment keys which determine the percentage rate used to calculate the value adjustment. So each and every document or each and every open item of the debtor will be with different amounts. So we can't adjust the amounts fully. We can adjust the amounts to particular percentage. So if we see the screenshot, define value adjustment. How do we define? So we will enter the value adjustment key and valuation area. If we remember, this is from foreign currency valuation. So days 30, debit interest, what is it, INT, I'm not sure, let me check. Debit rate is 5,000. So valuate manually, external valuation, net amount. So once the key is created, the key is assigned to the customers, and also this will be assigned to only customers for whom you want to perform the flat rate adjustments, not for all the customers. You also configure the account determination for the automatic postings here. When executing the valuation run, you enter the parameters for selecting the items. So here if we see, this is a value adjustment parameter screen. In this screen, it is like again foreign currency valuation run or payment run. So it is similar to kind of that run on, and there will be identification, and there in the background it will create an SN35 batch session. So currency type. So whatever the required parameters we will update in this screen. So you must enter the valuation method 3. So we will enter the valuation method as 3, flat rate, individual value adjustment, and key date for the run, usually the last day of the month. Okay, and you also enter a valuation area, the same as defined for the foreign currency valuation. So the same thing we will update here, valuation area. And the other definitions are optional, but if you want to generate postings, you must select that option here, postings. Proposed valuations are created during the proposal run, and you can change these proposed values manually. Okay. After processing the proposal, you execute the valuation run, and this posts the adjustments in financial accounting. So once we process that proposal, it's similar to payment run. Once we process the proposal, we will execute that valuation run, and this in turn posts the adjustments to financial accounting. After this, we can use standard reports to confirm the result of the valuation. So that is about value adjustment. So normally we do adjustments for debtors like customers, because those are the persons from customers are the ones from where we don't sometimes receive the invoice payments. So as a suppliers, means like, yeah, we will be suppliers, and if we want to pay to the suppliers, then without any restrictions, or with if there is any disputes, we might not pay to the supplier, but most of the times, in most of the cases, everyone pays to the suppliers. So but if we understand, bad debts will happen for many reasons, so that's where this value adjustment configuration comes into the picture. Accounts payable or accounts receivable regrouping. So we have another activity where we do regrouping. You perform regrouping for customer and supplier accounts in the following cases, and depending on the local and corporate accounting regulations. You must display receivables and payables separately. In this case, you need to transfer amounts for suppliers with a debit balance to a receivable accounts for the balance sheet. So if there is any debit balance with the suppliers, transfer amounts for suppliers with a debit balance to a receivable accounts for the balance sheet. If we need to receive any amount from the suppliers, that needs to be transferred to the receivable accounts. You group payables and receivables based on due dates. Example, short term, mid term, long term. Regrouping will also correct and align amounts on accounts if you change the reconciliation account of a customer or supplier in the master record. So what does that mean? What actually regrouping does is, it will also correct and align amounts on accounts if you change the reconciliation of a Okay, sometimes we will change the reconciliation account of customer and supplier. So even in those times, if we regroup, that will be grouped correctly to the respective reconciliation accounts. You use a specific regrouping app to perform these tasks based on settings you configure in customizing. So we have sort methods. So when customizing the sort method, you define the rules for receivables and payables separately. You define which account types will be transferred per time unit, usually number of years. So if we see in the screenshot, so first let us see the theory, then we move on to the screenshot. For example, when vendor receivables, that means vendor with debit balances must be transferred. You also define the accounts that are used for regrouping posting. The account definition is based on the original reconciliation account. You also define the accounts that are used for regrouping posting. So the account definition is based on the original reconciliation account. You define the adjustment contra account and the target account. You can see all the selection parameters available to specify when performing the receivable or payable regrouping. So this is the screenshot for receivables from 0 to 1 year. Description is receivables less than or equal to 1 year. So vendor posting, GL posting and the account. And from 1 year, that means the receivables is greater than 1 year, like customer posting, vendor posting, GL posting, and that account screen looks like this: chart of accounts and the transaction V000. So with that combination, so that reconciliation account comes from the vendor or customer master data, and to which we need to adjust, and which is the target account. So adjustment account and target account. So only once we practice, then we will understand this. So this is a basic information of how regrouping works. So if we have a customer or also and is an affiliate has partner main master record, you select partner grouping for the amounts to be consolidated in one record. Okay, this sort method, the valuation area IF. If we see in the parameters, we have selected in the right side of the screenshot partner grouping. Reconciliation accounts for affiliated companies are usually separate. Correct. If you select the changed reconciliation account option, okay, where is that changed reconciliation account option? Other parameters. Okay, it is on the right side. The system will report all the items of the changed account using the new reconciliation account from the key date selected. So if you select the changed reconciliation account option, the system will report all the items of the changed account using the new reconciliation account from the key date selected. Okay, just before we have discussed, right, if there is any changes to the reconciliation of the master data, so while regrouping, it will regroup based on the new reconciliation account. You can see an excerpt from the analysis log presented after executing the regrouping run. You will be able to see the results clearly on the balance sheet report for the key date specified. So these are the few options in what is this regrouping. So one is partner grouping and one is change reconciliation account. So this is the thing which I explained in the, you will be able to see the results clearly on the balance sheet report for the key date specified. So what is that log after executing the regrouping run? So this is account type D, previous reconciliation account. No, it's previous receivable account and net due date and document number, posting date. So target company code 1010, regrouping analysis. So document type is RV, amount valuated, this is the document number, and this is the previous account, and this is this account should be the TOVW1 should be the new account. So now we move on to closing activities in materials management. So if we, as a financial consultant, we also should be familiar with few activities concerning the integrated closing process with materials management. These include managing the physical inventory documents, clearing the goods received or invoice received accounts, and evaluating material stocks. So physical inventory. How we will check the physical inventory is a business process in which the actual physical stock is compared and matched with the stock in your books. It is generally a legal requirement to carry out an inventory at least once a year. You perform the inventory for your own stock and special stock, example items held for third parties. There are various types of physical inventory such as the following: periodic physical inventory, continuous physical inventory. So in periodic physical inventory, all stocks of the company are physically counted on the balance sheet and the entire warehouse is blocked for materials movement while the inventory is ongoing. In continuous physical inventory, stocks are counted continuously during the fiscal year. So here it is important for every material to be counted physically at least once during the year. Cycle counting, and one more type, cycle counting. In this type, stocks are counted at regular intervals within a fiscal year. So these cycles are configurable through the cycle counting inventory in the material master records. So as we don't know much about material master record, so if we see the material master record, it seems there is an option for cycle counting. This method is best for fast moving items. You update your books per the quantities counted in the physical inventory. The delta is posted in materials management. A sample of such a document is provided. So now if we see the screenshot, display physical inventory history. This is the material and location of physical inventory. This is in plant and the storage location and this. stock type warehouse, and physical inventory status is counted and adjusted when we have counted, which is the posting date, last count date, material, document. So if we see the quantities and value section, the quantity is 11 pc, but book quantity is 11.118 pc. So the different quantity is 118, it's minus, and the difference amount is 6.243 and 38. It should be actually in decimals, right? So 6 euros, if we say, it is like 6 euros, and difference quantity should be in decimals. I don't know how it displays decimals in, it should be 0.0.118. Okay, so now the main important to all finance consultants is GRIR account clearing. So here this mainly about physical inventory, how the inventory is counted and how they will manage to check the inventory regularly. So this talks about GRIR clearing account. When there is an inconsistency between the quantities delivered from the goods receipt and the quantities invoiced, these are posted to the goods receipt or invoice receipt clearing account. So when there is any consistency between the quantities delivered and quantities invoiced, these are posted to the GRIR clearing account. So if we see here, the group is WRV, and the procedure invoiced but not yet delivered. The invoice is received but the delivery is not received. The transaction is BNG. It is delivered but not yet invoiced. That is GNB. Wow, it is an reciprocal of the before one. Okay, and account determination. If we see, the it is a combination of chart of accounts and transaction, and it is like reconciliation account, adjustment account, and target account. So GRIR posting. Periodically on a key date for reporting, you clear the GRIR account by transferring the values separately to the invoiced but not received account and the received but not invoiced account. You can see the result of the clearing run. In this case, a quantity of 50 has been provided, however, it hasn't been invoiced. So if we check this screenshot, we can see the goods was received, but there is no invoice quantity. The difference quantity is 50. So GRIR clearing posting. So we also can see the detailed posting journal entry screen for the clearing run. The value of 2500 comes from the price of the material multiplied by the quantity. 50 quantity times 50 value. So header, journal entry, posting date, posting period, and Type is KP and company code transaction, reference transaction, header text, and who has created this. Journal line items 1 and 2. So one is GRIR clearing account and other is purchased services, and the profit center is same, and GRIR 2500, and this one is credit. Purchased services is credit. GRIR account is debit. This is the entry view. So in the header of the document, you also can see related documents that are referenced by the goods receipt or invoice receipt. So by the that are referenced by the goods receipt or invoice receipt clearing, the document is reversed at the same time with a reversal on the first day of the next period to not affect the daily business operations. So even these are main financial closings are mainly for reporting purpose. So in order to show in the books, they will post this clearing transactions, and again they will reverse in the first day of every month. So now we check on stock valuation. So there are three types of stocks that you are required to evaluate. So raw materials, supplies, and consumables, or SC. These are materials commonly bought from suppliers and are often managed by the moving average price map method. Work in progress. WIP materials, also known as semi-finished goods. These are usually produced by the company and are often valuated at the standard price. WIP can be broken down and shown analytically on the balance sheet if this has been customized. Management accounting consultants often carry out this configuration, and finished goods are the products produced in-house and are generally valuated at a standard price. You can update the balance sheet based on the calculated material prices and quantities using the balance sheet values by account app. So balance sheet values by account. So there are different types of stock. So let us see the screenshot. So material, restriction of selection, plant, valuation type, material type, valuation class, material group. So balance sheet values by account, selection screen, database update. So this app enter the values on the balance sheet in accordance with the inventory in the books and the prices calculated for the material. So what does this app do? This enters the values on the balance sheet in accordance with the inventory in the books and the prices calculated for the material, and you can see the output from your run without differences. Now let us check the FI certification related questions regarding this topic. Which activities are supported by the regrouping program of receivables and payables? So what does the regrouping program do? So the regrouping and clearing, it don't do any clearing, it just regroups. So on clearing open items for affiliated companies on customers and vendors. If it is regrouping open items, I think then that might be the correct option. I don't think it does clearing. Regrouping receivables and payables by the remaining life. Yes, we have seen less than 1 year and greater than 1 year. Based on that, we can regroup the information. And also regrouping of receivables and payables to accrual earnings or expense. I don't think so. Regrouping open items based on changed reconciliation accounts. Yes. So the answer is B and D. In stock valuation, which of the following groups of stocks are valuated? So it's not goods invoice, it's finished goods, work in progress, raw material supplies, and consumables. So it is B, C, and D. What should you check if the balance of the GRIR account is not zero at the purchase order item level on the balance sheet key date? So what should we check if the GRIR account is not zero? To check if the goods were delivered by the key date but have not been invoiced. Yes. To see if the goods were produced, we don't check any produced ones, we don't check any goods which were ordered ones. So which are delivered and which are invoiced. Check to see if the goods were invoiced by the key date but not have been delivered. So it is A and D. So with this we have completed the few more activities in financial accounting. Still there are few means like financial closing cockpit and few more, and let me cover the remaining activities in another video. Thank you so much. Thank you so much for watching. See you soon in the next video. Thank you.